Yesterday was fairly mixed across the S&P. We had lots of industries performing very strongly, notably the industrials, semiconductors, but there were also others that actually continued their poor form. Adobe, under the spotlight today, was pretty much flat. Now, when we zoom out to the last 5 days, in fact, we're seeing lots of green across nearly every single company, and that is also what we've noticed for Adobe. It's been up around 8%. Now, bear in mind, investor sentiment is quite shaky. We are flickering between both fear and extreme fear. There is a lot going on in the market that is getting investors a little bit on edge, and earnings season may give us a better indication of how we're going to end 2025. Lots of big names still to report. We're talking about the Mag 7 next Wednesday, the likes of Meta, Microsoft, Alphabet, and Apple reporting the following day on the 30th. Now, Adobe that we're discussing today is towards the end of the earnings cycle. They're estimated to report around the 11th of November, and this is a company that when we do zoom out to the last 20 years, they're up nearly 1,000%, although you can see in the shorter term, it has been a little bit rocky. In fact, when we look at just the last 12 months, not only have they been in a downward trend, but they're down 27%, telling us they've lost more than 1/4 of their market cap. If we zoom even further to just look at 2025, where they're down 20%, 1/5 of their market cap just wiped out, and investors want to know, is this one to perhaps buy on the dip, or maybe this is one that will continue to fall, perhaps a falling knife? And you can see if we zoom out to 2005, this one has had more strong years than in fact weak ones. It's just unfortunately looking like since 2010, 2011, where it had back-to-back negative years, 2024 and 2025 seem to be a repeat. Question is, can they come out of this negative trend? And we can go and hear what Jim Cramer spoke about this company. It was one he was very bullish on, in fact, in just the last few years.
Next up is Adobe. Don't chew with your mouth.
Want me to fill for a second?
On the 11th, Adobe's going to report. This is this battle between these software companies that are not software as a service and software companies that are. And Salesforce was a brutal come up, and it was tough for me too to watch. I kept thinking it had to stop going down. I'm wondering whether Adobe keeps.
Do you think not getting Figma was a blessing or a curse?
Figma was way too high. I think not getting Canva. It needed to be.
Yeah.
Canva's what you have to
do. You need
that both. But what's interesting is both Adobe and Salesforce. This is unusual. These are amazing companies. They're great companies, and their products are good. Nobody cares anymore, because these are the ones that people think are just being blown up by AI. So these are the ones that are real casualties.
Right, and you think that's a clean narrative? Because we have seen reports saying it's been overstated.
I've been fighting it, Carl, and I got to tell you, I've been so much soul searching about this, back and forth with Mark Benioff too. I'm just almost worn out.
These were some of your favorite names a few years ago.
I was talking about it with Nikesh Arora from Palo Alto. He goes, Jim.
As we heard, this was one of Jim Cramer's favorite stocks in just the last few years, but the narrative is very clear. AI is coming to take away the business, not just from Adobe, but we also heard Salesforce, or that is at least what analysts are starting to believe, and that is what we're seeing in the share price drop today. However, what we're also seeing is over the last few years, and in fact even further if we were to stretch, Adobe's revenue has been increasing year on year. 2021, 13 billion. In fact, if we look at 2025, 22 billion, and the trend is very obvious. Sales is going up, but in fact share price is going down. We can see Adobe was trading at $634 at the end of 2023. They were reporting revenues just below 20 billion, and when we zoom forwards and look on a trailing 12-month, now sitting at 23 billion top line, well, the share price has dropped significantly to $354. So is AI really going to kill this company, or in fact has the market got this one so obviously wrong? Because we're also seeing the same with the bottom line. It isn't just the revenue that's been increasing over the last few years, it's also their net income. They reported 5.3 billion 5 years ago, and now sitting at 7 billion. So it is very obvious the underlying metrics of the company are in fact strengthening. it just looks like confidence is in fact faltering by investors, by analysts, and those who like to speculate. We can also see how their most recent earnings was.
About 6%. Haven't said that in a while. Mackenzie Sigalos with the numbers. Matt?
Hey, John. That a 6% bump up coming after a beat across the board. We've got adjusted EPS of $5.31. $5.18 is what the street had been looking for. On revenue, coming in at $5.99 billion versus $5.91 billion expected. We've got a Q3 ARR for the digital media business. This includes its creative cloud subscriptions that came in at $18.59 billion during the period. That is above the consensus of $18.56 billion. And then we're seeing a beat on guidance for Q4. So looking at EPS, it's in the range of $5.35 to $5.40 versus $5.34 expected. Q4 revenue guide also coming in above estimates at $6.08 to $6.13.
So this is what we would call a very strong performance in terms of their earnings. They had a double beat both on their sales, both on their EPS, and not only that, they've also extended their guidance, which analysts will love to see, and that is why in the previous earnings their shares were up. We can have a quick snippet where they saw $6 billion in revenue and 11% year-on-year growth. And remember, when companies do report earnings, it isn't just their sales, it isn't just the EPS that analysts will look closely at. It is in terms of their guidance, will it be an increase? And that is exactly what they produced. $23.7 billion there or thereabouts, and it was up, although very slightly from their previous figures, still showing that Adobe is producing the numbers and management have the confidence this will in fact continue. And earnings per share was also increased, although very slightly. Again, very strong overall. And nothing that doesn't get talked about by companies like Adobe that don't in fact pay dividends, although this one did quite some time ago, is that they return excess cash to investor pockets through share buybacks, and they do so quite aggressively. If we look at 2018, so we're talking around 7 years ago, it was at 491 million. Now we're seeing this down to 447. It is something they continue to do and is always great for investors, as we said, when we don't get dividends. And if we look at the yield, effectively in 2024, they bought back around 3% of those shares outstanding, something they continue to do, although some years a little bit more than others. Again, a very positive thing to note overall. And it's always great to see what are politicians in fact doing themselves. We have here the most recent purchase by Marjorie Taylor Greene. In fact, she released this information on the 21st of October, actually bought shares on the 15th, and that maybe is a signal that this is one that could in fact rise. We also note she added again on the 11th of September. Now, there are also others in fact who have sold over the course of 2025, but this is just one extra layer that we like to include, not necessarily dependent on whether you should buy or sell. And more importantly, what is the value of this company? Is it undervalued? Is this one that maybe we should steer clear of? Well, if we just look at the difference between the price and the average fair value over time, we can in fact see the fair value in 2021 was below the share price of $617. Now we're seeing this completely change. We're seeing the opposite effect. Fair value $597, the price at $354. Now you can see that this is made up of these four different valuation models to give us the average, meaning it's trading 70% or there or thereabouts below the fair value. And when we compare this to our own intrinsic value, we do see this slightly lower at $519. And remember, we typically run it through a DCF model where the average growth over the last 10 years has been 23% year on year. We've used 8% moving forwards, and this flags that right now, based on these assumptions, baked into the price is 2.7% moving forwards. Whether you see a DCF at 4, 8 or 12%, we see each one with upside, in fact 12, nearly a 2x, and this in turn does give a margin of safety around the 32% point. Wall Street themselves see this at 460 on average over the next year, alluding to 30% upside into 2026. And we can see Adobe specifically does currently sit in the neutral when we look at whether it's overbought or oversold. So the question is, it looks to be undervalued no matter what metric we look at, and this is a company that the sales only have been continuing to increase over the last 10 years. The net income also reflecting an increase over the period, but the valuation is one that now seems to be getting cheaper and cheaper. So at what point does this now look like a very strong buy? Let us know your views in the comments below. Is this one that is a buy, maybe a hold, or a complete avoid? And if you enjoyed the use of the software of Forecaster today, then do click on the pinned comment below. As always, have a great day, and we'll see you all on the next one.